It is nearly upon us. As we head into October, we are fast approaching the autumn budget statement, but it certainly feels like this budget, more than ever, has got people a little spooked.
Spooky.
All of the talk in the run up to this budget would lead you to believe that we are likely to see tax rises. We've had talks of black holes in the public finances.
Now, as well as spending and pay, there's another black hole.
And with many of the taxes that Labour could change seemingly off the table, you might think that perhaps pensions are sitting in the firing line. Apparently, the older generations weren't quite as keen as the younger lot were to see Labour come into power after the recent election. But let's try to take some of the sting or worry out of this. Let's have a look at the potential changes that Labour could make to pensions taxation, things like tax-free cash, which I know has been troubling quite a few people out there. And then we'll look at, is there anything that you could or should be doing based upon this? Hi, my name's Andrew. I am a chartered financial planner in the UK. If you're new here, tap that subscribe button for plenty more to come in future. And if you wouldn't mind, push the like button, as it does help in getting this out to a wider audience. First off, let's have a very brief recap of what makes a pension, so we're all on the same page. We're not going to talk about the state pension here, we can do that another day. I'm talking about saving for your retirement through work or of your own accord. In this sense, a pension is defined by the rules around the tax treatment and the access to it. So to start with, we have tax relief on contributions, that's money into pensions, a bit like a refund of the income tax you would have paid on that contribution amount. You've then got tax efficient growth within the fund, so HMRC can't take a slice of interest, dividends and capital gains. On the way out, as you take money, under current rules you can take a quarter, 25% of the pot as tax-free cash, and the remainder will be subject to income tax in the years that you draw it. We've got some pretty favourable treatment for death benefits if you should die with the money. In a pension, it sits outside of your estate for IHT. And really, the only trade-off for this is that you can't access the money until you reach the statutory minimum pension age, which is currently 55, due to move to 57 shortly. And of course, this is one of the things that governments could tweak in future. But why would any government want to offer a tax-advantaged account like this in the first place? Well, of course, the hope is that it will incentivise us to provide for ourselves in retirement, with that forced discipline of access beyond a certain age. Ultimately, this is about reducing reliance upon the state. And now that we're clear on what a pension is and why we have one, what is it about the pension that the government could tweak or change in future? Well, to list these out, we might see changes to the tax relief on money into pensions, contributions made. There's been the annual allowance in place for a while, it's at 60,000 at the minute, we could see changes to that level, or perhaps changes to the rate of tax relief offered. So currently it's on a marginal basis where higher earners can get higher or additional rate tax relief, and there has been talk at plenty of years about flattening this out to perhaps a 30% rate or capping a basic rate relief. Within the pension, you could change the taxation on the growth of funds. I think this is unlikely given it's a cornerstone of a tax-advantaged account, but it's one area you could look at. You then get to the age of access for a pension, and again, I don't think this will be a big tax generator, as you actually want people taking money out of pensions and drawing that down, so deferring that would defer some of the tax revenue the government could get, which brings us maybe to taxation on money out of pensions. So you've got that 25% tax-free cash amount, and then the income tax that they take on income. Could you make changes to either of those features? And finally, the death benefits from pensions. They're quite advantageous at the minute. Is that an area the government could go at for tax revenue? Now I'm going to dig into 3 of those potential areas for change in a bit more detail to give you something to consider. But before I do, I just want to make it clear that my vote of preference would be no changes whatsoever. I do not want to see constant changes to the taxation and access of pensions. It undermines this comfort and trust that the public need to have if you really do want to incentivise us to save for our retirement. I've been advising for a relatively short period. I joined financial advice as a profession back in 2011, and in that time frame we've had the annual allowance up and down, we've had the lifetime allowance come and go, we've had the money purchase annual allowance at 10k, then 4k, then 10k, and 2015 saw a whole raft of changes. Now sometimes these can be for the better, but on the whole I feel like it undermines the trust that we have in pensions. ISAs have been relatively unchanged since their introduction, and people tend to trust this. They feel a lot more at ease with saving into this, whereas pensions, through their complexities and changes, tend to get a bad name for themselves. So my vote would be for no changes. Let's start here with the potential for changes to tax-free cash. So this is known as the pension commencement lump sum in pensions jargon, and it's that 25% lump sum that you can draw from your pension without being subject to income tax. Now the obvious ways to tweak this would be to either reduce the rate, so take the 25% down to a lower rate, or remove it altogether, or reduce the new individual lump sum allowance that we introduced this tax year and bring that down from the current allowance of £268,275 that you can take as tax-free cash during your lifetime. Now, I am not making any predictions in this video, but it seems obvious to me that if the government did want to make changes here, it seems easier and more palatable to reduce that individual lump sum allowance, bring that monetary amount down, the amount that you can receive during your lifetime, rather than go after the rate of tax-free cash. Because if you, for example, just flat out take away tax-free cash, it will impact on all pensioners, and you can already see the angle that poorer pensioners would suffer. So I think from a ease of getting this through and not having as much backlash, plus just the practicalities of implementing it, given we already have an allowance and you could just adjust that number, I think that would be more likely than it would be that we see a change to the rate. If, hypothetically, you brought that allowance down to, say, £100,000 as a nice round number, the IFS has estimated this would impact around 1 in 5 retirees. And I think it's likely to have most impact on those that have the intention to take a large one-off tax-free lump sum. Because if you were going to take, say, 268,000 and now you can only get 100,000 of that tax-free, well, that excess lump sum would stray into the higher rate tax bands and you'd have more of a tax burden on it. And I mean, it's not that uncommon for people in the public sector like doctors, teachers, etc. to have accrued a lump sum entitlement that's into 6 figures. So it's not just the super wealthy that this would impact. Out of interest, I created a very quick draft case study here to look at an assumed 60-year-old that's retired with a full state pension due at 67. And I've assumed that they've got a defined contribution pension pot valued at £300,000, and they're going to gradually draw down on this through income drawdown. Now, if we take the current rules and assume that they've still got the 25% tax-free cash entitlement throughout their lifetime, then with all of the other assumptions I've baked in, they could spend roughly about £20,615 a year in today's money for the rest of their life, with an assumed mortality age of 90, nicely running out of money at that point. But if we take that exact same scenario with all of the same assumptions, but crucially we take away the entitlement to tax-free cash, so reduce it from 25% to nil, the difference in what we can spend, net spend each year for this client, goes down to £19,971 a year. So our client is £644 a year in today's money, increasing with inflation, worse off throughout their lifetime. And this, from a tax perspective, if they withdraw those sums, means that the person that had no entitlement to tax-free cash pays about £99,000 of income tax throughout their lifetime, whereas the person with the 25% tax-free cash entitlement would have only paid about £70,000 in income tax. So it is a notable difference, but perhaps not life-changing in the sense of roughly about £640 a year for a client with a £300,000 pot in this scenario. But what could you do if this was troubling you? What options do you have if you want to protect against any potential changes to a tax free cash entitlement or allowance? Well, the obvious answer is to take more or all of your tax free cash entitlement prior to the potential changes. But I do want to heavily caveat this that it's not a straightforward, obvious answer. There will be other considerations. Firstly, if you withdraw this tax free cash, will there be the temptation to spend it when perhaps you weren't going to before that, just because it sat there in the bank account burning a hole? And where does this knock on to your wider retirement planning? Then, secondary, if you are going to retain it, will it sit there in cash now rather than being invested like it would have been in the pension? Are you going to invest it in the same way, or will it sit in cash subject to inflation risk? And with money outside of a pension, keep in mind that if you can't shelter it under ISAs, and particularly for larger lump sums that might take some time to shelter that money, you might find yourself subject to tax on the interest and dividends or capital gains that again you wouldn't have had within the pension. So it's not straightforward. There are things that you should consider, and as always, I would encourage you to plan to what we know and adapt as things change rather than speculate. Another potential area for change would be to the taxation of death benefits. So, if you die with money in a pension pot, as I've mentioned, the tax treatment's pretty favourable at the minute. If you were to go before age 75, your beneficiaries can draw the money down tax free. And if you go beyond age 75, the beneficiaries would still receive the full pot, but could just pay marginal rates of tax in the tax years that they withdraw the income. Now, if they do receive it as a lump sum, there is an overall limit to the lump sum death benefits they can receive before they would pay some additional tax, and that is known as the death benefit lump sum allowance. It is, funnily enough, what was the lifetime allowance that has now been abolished, so it's just over the £1 million mark, and you can see that most people are probably not going to get caught up by this issue. We've also kind of got the loophole that for bigger pots, larger pension values, if you cascade that down the generations through beneficiary drawdown, so that the next spouse or child or grandchild takes the pot as a pension drawdown fund rather than taking it as a lump sum, they wouldn't be hit by that upper limit of the lump sum death benefit allowance. So in theory, you could just keep cascading money down the generations. And if these are people that have big estates in other areas, so they've got lots of savings, properties, and investments outside of pensions, they probably wouldn't draw down on their pensions in any event. And that isn't really great from a government perspective when they want to get their hands on some of that tax, and would have done under previous rules with a lifetime allowance. I suppose the changes that I could perhaps foresee on death benefits might be that we see a reduction to the death benefit allowance, so bring that down from just over £1 million to a lower figure. You would imagine that they will try to close the loophole on the drawdown aspect I've mentioned, perhaps have a tax as money passes from one pension holder to the beneficiary in drawdown. Again, that might be a monetary allowance. Or you could perhaps reinstate the lifetime allowance. Again, I think that would be messy. We've just got rid of it. We've got tons of transitional protections, so perhaps that one wouldn't be too viable, but somewhere around those three options to take some more revenue from the death benefits on pensions. But even if there are potential changes to death benefits here, I don't think it will be pushing me towards certain actions. I mean, what can you realistically do? You could draw more from your pension, spend it during your lifetime. If you don't need the money, you can withdraw it and gift it to others. But you might want to keep in mind your other assets in your inheritance tax position, maybe your age and your health, as it might be more advantageous to leave money within the pension, depending on your circumstances. And I suppose the only other real change to a pension pot would be that you could annuitize, buy an annuity, and build in the death benefits that you feel comfortable with from that angle. There's not a great deal that I would personally be doing based on potential changes to death benefits. And lastly, we could always see changes to the tax relief on contributions into pensions. So for some time now, the last couple of tax years, we've been working to a £60,000 annual allowance. You would imagine that Labour perhaps perceive that as higher than it needs to be. Just a guess. Again, no predictions in this video. Reducing that annual allowance, it has been lower in the past, would be easy, I suppose, quite palatable. And let's be honest, most people can't afford to save £60,000 a year or more with carry forward of their annual allowance. It tends to benefit high earners, company owners that can make large employer contributions, so I don't think it would be that difficult for Labour to make a change to that limit. The more controversial one would be a change to the rate of tax relief, and I really don't love this one for the complexities, and I do think it would disincentivise a lot of people to be saving towards their retirement, so I wouldn't be keen on seeing that, but who knows, we'll see what the budget brings on tax relief and perhaps the annual allowance changes. And what can you do if you are anticipating potential changes to the annual allowance or tax relief? Well, if you're a basic rate taxpayer that's hoping for an uplift in the rate of relief to 30%, and you're thinking about a larger pension contribution, you might want to hold off. It may not materialise and you could have lost out on time in the market, but that's your option. Whereas I think for most people, it'll be more about reductions in the annual allowance or reductions to the rate of tax relief they might achieve. And in that case, well, you might think about making contributions sooner rather than later. Again, there may be no changes at all, and hopefully we'll see sensible long-term thinking when it comes to tax relief and the annual allowance. So there we have it, my take on some of the noise, some of the speculation around changes, potential changes of course, to pension legislation or taxation. I hope it's given you some indication of what's out there, what's happening, and whether you should be considering any action. In the main, my core message is plan to what you know, try to avoid speculation, and adapt your financial plan over time. We know there will be changes. We've seen plenty of changes in the past. There will be some in future. And sometimes we get proposed changes that get unwound pretty quickly. So don't let it trouble you too much. I hope this video has been something of a reassurance on that front. If you are looking to work with a financial planner in the UK, my contact details are in the description. Always seek someone that's independent and knows the retirement space well. Thank you as always for watching the video. Drop a like if you wouldn't mind, and I hope to see you for a future one.